Good morning, everyone. Welcome to the room. As you know, trading futures involves risk and is not suitable for all investors. The information in the presentation is for educational purposes, not a trading signal service, not intended to be financial advice. Hope everyone had a good weekend and a good Monday. Shaping up to be another good week. This morning we had consumer price index. Redbook a little bit later today, but not usually a big market mover in terms of economic news. We're on a new contract. Last week we had both the March and the June contracts trading for futures, and then now we are just on June. March expired. Get my profit charts going here. A little bit of a gap up today from yesterday's close, but still within yesterday's range. In yesterday night's video, I talked about how breaking the downtrend here, the top of the triangle, we could come back into this next 50% long. And a lot of times what happens is you get a larger level, a major low to high that pulls back. And then before we get all the way to that negative 23% target, the market makes a pullback to its next retracement. This is more often than not, sometimes you see on a daily chart. But we could also roll over, and this swing low down here is going to be that major breaking point. So if we come down, break the swing low, break this 26.29s, then I would see us coming down, breaking this major low that we had back in the beginning of February, and likely having a big down day in the Dow, and then rallying again and closing up at a hammer formation. We've got a pretty strong open, 3-to-1 on the breadth, 1500 on the advanced decline line, a couple of high tick prints right off the open. Those should settle out, and then we'll kind of drift down to the zero line in the next 20 minutes or so. Let's see, later this week, retail sales, jobless claims, housing starts, consumer sentiment, housing market index. So Thursday, Friday, some good indicators or some good economic news coming out. Could shake things up, could really accelerate, even if the numbers are just okay or flat. That could be the confirmation that the market needs to break through to new highs. Overnight was decent. A little consolidation this morning. Another triangle formation, kind of very similar to what we have over on the left chart, the daily ES. A triangle formation, just meaning that the market is making lower highs at the same time it's making higher lows. Here we have lower high right here, and then higher lows on the way up, sort of converging right at this we'll call it 2800, which makes sense. A big round number. The market's going to gravitate towards those types of levels. take a look at the 30-minute chart, we can see a pretty good trend off of lows, this 2660. We've gone a little bit straighter, a little bit more vertical on Friday, but then yesterday we've drifted a little bit more sideways, and now kind of starting the day at yesterday's highs, which is a good sign for the bulls. I like to start the day with the overnight session on, and then I'll turn that off once we get a little bit into the day. Now the trend the last couple of weeks has been to have sort of a slower first hour and then get moving at least after 30 or 45 minutes. So we'll see if that happens again today, where the initial trend on the morning sort of fails. Whereas yesterday, the first 30 minutes we traded up, and then we had this nice little hour and a half downtrend. Friday sort of broke that trend. It's the first time in a while where we traded nicely trending to the upside. None of the candles broke the previous candle's lows. Each candle continued higher. But see, like last week here, first hour and a half trended one direction. First hour and a half here, first three candles. Then we got a reversal. And we got this short reversal. Three sideways candles, and then the trend here on Monday of last week, we had two sideways candles, so just an hour of consolidation, and then we got the trend. Last Thursday was a little bit longer, sideways most of the morning, and then the trend developed. Again, two sideways candles, and then you get the trend. So you kind of get the idea, sideways and then trend. So that's been the pattern, and that pattern is starting to shift a little bit. At least it felt that way. Definitely we saw that on Friday. And yesterday, we started to see some trending, as well as Thursday, trending within the first hour. So those are some of the things that I look for. What are sort of the patterns that we've seen throughout the last couple weeks? If we take a look at the market profile, just to get a start on the morning. So yesterday's chart looks like this, where we had a lot of price action down here, 2790s, and sort of in this area, also known as the value area. Price extended down to the previous day's value area, and it extended up. This was actually the open, the first 30 minutes. Then we moved down on the day. Today we're opening higher, opening at 2801.50s. So you can see our open higher than yesterday's open, but still within yesterday's range, and then getting a little bit of an extension. Now, as we start moving through the morning, I'll just continue on with the letter A for the first 30 minutes, and then move to the letter B. And then that gives me this developing profile for the day, and we can see where the market might be headed based on previous support and resistance areas. If we go to the left, we see that there's really not much behind us. If we move up, obviously the last few days have all been coming up from the bottom. A lot of consolidation in price below us. So there's not a lot of resistance to the left of us. And that's pretty clearly made visible by this daily chart. When I talk about to the left of us, price is over here on the right. Well, to the left of us, a lot of these bars are just single. We traded one day and then moved higher. Then we had this 4-day consolidation where price overlapped. Then we moved higher. 3 days of consolidation, and then price went higher. But other than these two little consolidation periods, there's not much to the left that looks like it'll be very strong resistance. So the gap is down at 89.50. That's yesterday's close. So we'll see if the market wants to go up first in the first half hour, and then if we roll over and come down and fill the gap, or if we sort of gap and go like Friday, where we gap up and then continue. So far the trend is looking pretty healthy with these developing lower highs and lower lows. I always like to wait 15 minutes for the market to settle out, get that reactionary trade out of the way before jumping in. And I've been waiting even a little bit longer the last couple weeks just because of that trend that I've been observing of sort of a little choppier off the open, or at least not a strong trend developing until later in the day. So I don't want to use my bullets for the day and then not have anything for a little bit later in the morning when things start looking good. Given that we are at 2,800, so the target on this 2660s is a 2,850. Might seem far away, but there's really not a lot in between us. There's this 28, we'll call it 2835 area. Just this prior consolidation area. But for the most part, now that we've broken the swing high, 2850s is definitely a strong target on the horizon. overnight low just about lining up with the close, swing low, yesterday's close. And that target, 50% at 27.95, has a target at 28.09s. So I'll just make a mental note of that. One little pullback thus far, right at the open. And then nice little trend. I like to see a trading hours only pullback in the first 15 to 30 minutes, meaning when I say trading hours only, just from the NYSE open, using whatever that lower high is to highs. At some point, the market's going to make that retracement in the day. And I want to see if there's participation or if it goes like a upside down V, where we go straight up the first 15 minutes and then straight down the next 15 minutes, and sort of develop then a range from the opening high and the opening low. And so when the last couple weeks, when we've been trading what I call that consolidation in the first hour, it's staying in that first 30-minute range, sort of going from the bottom to the top to the bottom, not really developing a trend until an hour into the morning. And so you want to be cautious. I like to be cautious within that range, because there has really not been a trend established. Yesterday, however, in that opening range, we started to see some nice trending, even though we did that straight up, straight down. Within that, what's different than the last couple of weeks is that we saw a nice series of higher highs and higher lows in the first half hour, and then a really nice sort of trend back down, where you can draw and visibly see high to low. Market moves up into the 50%, trades down to the negative 23. From that entry down to lows, market moves up into the 50, down to the negative 23. And so that sort of participation, when I talk about participation, that's what I'm looking for. Market reacting at the 50%, trading down to the negative 23, trading at the 50% again, and then moving lower. Here's that nicey tick drifting down to the zero line. Breath still strong, meaning there's still a good amount of volume going into stocks that are moving up 2.5 times, to be precise. The amount of volume is moving into stocks that are going up versus stocks that are moving down. And then the number next to it, 1372, it's the net number of stocks that are moving up versus down on the NYSE. can see the NQ leading already into new highs. It was less of a triangle and more of a ascending triangle, sort of knocking its head up at highs. YM looking similarly to the ES, not quite breaking out of its previous swing high yet. So you've got the NASDAQ looking the strongest, then the Dow, then the YM. When you're looking at the markets, just like in sports, fundamentals are really where it's at. Even, very high level professions, doctors, lawyers, very high precision, technique based professions where it takes years to develop kind of the art side. Those core fundamentals of identifying the trend, identifying the market structure based on the very simple highs and lows and where the next high is in relation to the previous high, where's the low in relation to the previous low. Just looking at a very simple candlestick chart can give you a lot of insight in what's going on with the traders in play, traders and investors. So the simpler we can make it with the least amount of moving parts, the better. And then so that's kind of the art side, identifying trends and patterns, and there's a little more subjectivity involved. And then from here, I'm going to draw up the low to high, see if we get a reaction here. Not going to take a blind limit just because the pattern in the last couple of weeks has shown that this first trading hours only has not really had a lot of participation, meaning we had a trend in one direction and then right after that we sort of trend in the opposite direction. So other than Friday's great trend day, our trend has been to, like yesterday, gap up and then come down and fill the gap. So we'll see if we do that again today. Gap up and then maybe come down to the what was that, 89.50. Come down and fill that gap. But from the scientific side, making sure that the risks that you're taking are calculated. You have a certain number of stops that you're willing to accept in a day, a certain dollar amount that you're willing to risk in one day, and that amount needs to reflect an amount that you can gain on one, maybe two winning trades. It does a lot for the psychological aspect, but just from a straight numbers perspective. So when you put the two together, the intuitive side, the subjective nature of trading, identifying the trend, identifying days and areas that are good to trade, meaning places that we're likely to get follow through. So if we trade down in this range from yesterday, we'll say an 85 up to a 95, there's likely to be a lot more back and forth, as opposed to if we come up and break this first 30-minute bar high, we're likely to get some stronger trending. See it here on the 5-minute chart. So if we get participation on this in this long, I'll draw up the opposing, see if we can get into a long setup. But it's only once I've seen the participation here this morning. Now you could say, well, the distance here between the 50 and the 61.8 is small enough such that a 6-tick stop, if you enter at 28.03 and a quarter, 6 ticks would be 28.0175. So that would put your stop below the 61.8. So from a, is this a valid 50%? Absolutely. What I'm taking into account is sort of the patterns over the last couple of weeks. So yeah, good question, Mike. When I say, I'm waiting to see participation, all that means is I want to see the market come down, touch a 50%, and then bounce at it. Meaning that, there are people buying at this level. There's involvement at the level. There's participation at that level. If we come back here to the open, if I were to draw from lows to highs, I would say, well, this is pretty dirty. The market, there was some participation and some follow through, but at the start, we traded through the 61.8. We didn't stop right at the 50 before reversing. So it's okay to have, to be patient in trading. But there's a fine line between waiting for your setup to occur and waiting for things to develop versus having 50 different indicators that you're waiting to all line up at the same time. And then you never get in the trade. So you can see no participation. The market just traded straight through it. That's been the pattern that we've seen. So now I'll mark, before I mark the high and low, I'll just draw the setup in the other direction. Notice no real, pullbacks, bounces on the way down, just sort of a straight move down to the bottom of the range. But let's mark the first 30-minute high and low. And if we can break out of the range, then, especially here, if we break down a little bit, should see a nice little, fairly quick run down to fill the gap. At least a lot of traders would like to chase that down. We don't have a low ticket lows. And you get this real tiny setup like that. They're definitely higher risk. And we've just broken by a tick, and then you get a very tiny setup. Like to see a little bit more of a break and some sort of sign here that we are entering into some retracements that are going to adhere versus just a one candle pullback. I'd like to see some, again, that word participation at a 50%. So it might be the trading hours only short rather than the trading hours only long. This 2802s might take us down, and then we can, if we get participation there, if we get a retracement at 2802s, then that might start our trend for the day down to the close. But in the meantime, you don't want to be stuck taking retracements in the middle of a range that's just blowing through the 61.8 and then blowing through the 61.8 of the other direction. So the benefit of the last couple of weeks has been the good trading has sort of extended later into the morning, but it's taken a little bit longer to get there. So now as I finish my first 30-minute candle bar for my market profile chart, we've got a high 7.25 and that low of 98.75. So now we've established our first 30-minute range. We can see we've come into yesterday's range a little bit. The close, I'll mark here, down below us. So we have all this space to fill our gap. And again, not much most recently behind us in the last couple of days or even couple of weeks. All the trading has been coming up from the bottom. Let's see, Abby. So in January, our consolidation was sort of up in this area. We traded a couple of days kind of like this, where we had price overlapping from 28.20s up to 28.50s. So a little bit of price overlap. On the way up, we were just trading basically one day at a price and then very little overlap and then a new high, maybe a touch of overlap and then making a new high again and continuing that trend. And so, yeah, we do have a little bit of this consolidation way to the left of our chart. I'm still using 28.50s as the target just because that's the negative 23% target of this 26.60 below us. But if the market were to roll over, they'd be totally expected or totally fine for it to pull back to its next 50%, which is then the top of the downtrend. And a lot of times that's a great place to re-enter or add to a position. We break the downtrend, break the swing high, and then retest it. And so once the market pulls back, that's a good opportunity to add to a long or get long. Yesterday's spinning top. Today, if we kind of roll over a little bit more, what I'd be looking for is us to break the previous day candle's low. So like we did over here, this candle breaks the previous day candle's low price. It was only a one-day pullback, but that's what we would need to see up here, break the previous day candle's low price to get a little bit more of a likelihood of a rollover. Otherwise, as long as we keep, even if we just have a very small range today, as long as we don't break the previous candle's low, then we could easily break out and go straight to 28.50s pretty quick. So definitely some good things to watch out for. If you can be active at the times, if you ask any trader, would you be okay being actively trading 2 days out of the week and sitting on the sidelines 3 days of the week if you knew that those 2 days that you were going to be active would be good days? It's almost like asking a football player, would you be okay sitting on the sidelines when the team's not doing well, and being on the field when you've got momentum and you're charging down the field towards the end zone? So it's kind of the same thing with trading. If you can be active and involved on these days that are either very nicely trending, or we're getting smaller trends throughout the day, that there's participation, there's trading at the 50% levels, involvement at the 50% levels, but also some follow through, and then just be patient through the other days of the week that may not have as much activity. Then you capitalize on the days that give you good setups, and just protect yourself on the days that don't. It's a very sustainable long-term strategy. Especially with something like swing trading, I see that all the time. There's weeks where seeing a lot of setups occur, and then I'll go through weeks where I've got some trades on, but there's really no new setups. And then I'll go through weeks where I don't really have any trades on because the market is not giving me any setups and I'm not in any trades. But when you get to the end of the year and you look and say, okay, well, what's my P&L look like? You can really do quite well by just deliberately being in the markets at certain times and out of the markets at other times. It's kind of the I know a few traders or a few folks who did do well in the tech era, tech boom, and they were smart enough to take some off the table and play with the remainder. The same thing goes for the whole cryptocurrency deal. If you invest $1,000 and that $1,000 turns into $10,000, and you take $5,000, you take profit on that, take it out of your account, invest it in something else, or spend some of it or all of it. Now the $5,000 that you have left, it's just gravy. And sure, it's still money, but in some ways it releases you from those emotions because you've pulled out your initial investment and then some, and then you're able to hang on to that position with less attachment, less caring, and then you end up having a much bigger return because you're not micromanaging the position. So that's where being able to scale out of a trade, trading 2 or 3 contracts. You don't need to necessarily be trading 10 contracts to make a quote unquote make a living trading the markets. It's more important to be able to effectively manage your trades and determine, is this a good environment for trading? Or is this an environment where I should be sitting on the sidelines? So here we come up, and coming into the 2802s, now it's an odd number, so I'm going to round down, add a tick, 2802.50. So again, I'm not taking the blind limit here. I mean, don't have an order just sitting here just because we haven't seen involvement from traders at the trading hours only halfway back for the day yet. Part of trading is being able to place a trade before it's very clear. When the setup becomes very clear, oftentimes, we're already way away from the entry, and you're looking back on it saying, well, yeah, I should have got in there, or I should have got out there. But, the other part of trading is taking cues on the previous couple of weeks and just being able to say, what have traders been doing the last couple of weeks? Where have they been entering, and what have good setups look like? Well, Thursday, Friday, Monday, we've had good setups when we've gotten outside of this first 30-minute range. And so, there'll become a point where all of a sudden we're seeing good setups inside the first 30-minute range, and then that day, a little flag will go off in my brain and say, okay, the trend is changing, and then I would be looking for more setups in the first 30-minute range. But for the most part, drawing the high and low like I have here on the first 30 minutes of trade, the high from the first 30 minutes and the low for the first 30 minutes, you can pretty much depend on that to be a range-bound area. Let's go back to Friday while we're not getting anything here. We go back to Friday and mark its high and low. And I know sometimes, especially for some of you who've been doing this for a while and been in the room for a long time, I'm sure some of this stuff gets beaten into you, but it all goes back to those fundamentals. And the more you can have the fundamentals driven into your brain so that when things get crazy and when it looks like, well, we're totally going to go higher today, and then we end up down 500 points and the market throws a curveball, it's really important to not have to think about what you're doing. When someone like Michael Jordan is on the basketball court, he's not thinking about all of the mechanics. Okay, I got to bring my elbow up. I got to, put my wrist back and get the ball square, my hips, shoulders. You're not thinking about all the little mechanics, but you do in practice leading up to it. So on Friday, if I mark the high and the low from the first 30 minutes, look at how quickly we exited and never returned. And on top of that, we had sort of this stair-stepping, higher highs and higher lows in the first 30 minutes. And then, boop, we broke out of the first 30 minutes, got a nice little pullback, a number of pullbacks within Friday's trade. Even within the first 30 minutes, you were seeing participation or involvement at the 50%. And then from that 50, two highs, market pulling back, stopping at the next 50%. So you're seeing a pattern develop, and then we break out of the first 30-minute range, pull back to the 50%, and we start to, sort of get our breakout, and then just really continue on and never trade back into that first 30-minute range. So that's a very good indicator, if you want to call it that, or a very good way to gauge the day using the first 30-minute high and low. And it makes a lot of sense. All the pit traders use the first hour's range, or they used to for a long time, and now we're seeing the first 30-minute range. And time, people's patience, things sort of speed up over the years, and the pits have dwindled, and There's not as many folks down there in the trading pits, so it makes sense that the first 30-minute range is being used a lot more. But a lot of times, a very common strategy was to wait for the first hour's range, or whatever that trend is. So if the first hour we moved higher, and then after an hour, you would place a trade in the opposite direction, anticipating that the market would make some sort of retracement. And that was what would kind of take you to the halfway back of the day. So if this up move occurred over the first hour, the traders in the pits would short at highs and then let it come halfway back. And that was sort of the standard practice in the trading pits, letting the market develop a trend and then trade counter trend after a certain amount of time has passed. So here a little bit more pausing. We haven't broken the 61.8, getting a couple of red candles ticking down. So we can see that there's a little bit more involvement by the bears as opposed to on the upside this morning. We just went straight through the short. So even though we had a stronger breadth, 3.5 to 1, now we're down at 1.5 to 1, meaning that now the amount of volume that's going into the stocks that are moving up versus moving down is a little bit more even. So more people are participating in the down stocks, or less people are participating in the up stocks, if you want to think of it that way. Another thing to consider is to the mass media, Dow up 175 is warm and fuzzy. So even if the market just drifted sideways all day and closed, there's, it's a big up day and a big win for the media, if you will. So the headlines have sort of already occurred. Dow up 200 points on its way to new highs. I don't know if that's an actual headline, but just making that up. But sometimes you get a big move down, but if we gapped up, let's say we come all the way back down and fill the gap, and it looks like on the chart, wow, we just, the Dow just moved down 200 points. But then you come over and look at your actual net change, and it's like, oh, Dow's flat. So what's the media going to do with that? Okay, well, Dow's flat. VIX has been spending more and more time below 20 as well. And then, even the ranges or the amount of time price opportunities that go into the market profile, the amount of trade that occurs has decreased quite a bit. And that's usually a healthier sign. It seems like, at least here in the Phoenix area, the home prices have, things are still moving very quickly. Houses are selling fast. Mortgage rates seem to have slowed a little bit. So there's still feels like and seems like good fundamentals in the markets. So now that we've come down, broken this little swing low, it's a good sign, starting to develop, potentially develop something here. I like to draw the opposing. So this is the main setup, the first setup, short. I'll draw from lows to highs. And I want to see, okay, yeah, it's great that we traded at the short, but do we just come down and trade at the long? And is there involvement or participation right here at the long? And is that going to be the setup that makes us break out? Or do we come down, break the 61.8, in which case then we can take the next short? Or do we come down and not make it to the short? Sometimes this distance between the short here, 50%, and the long 50% is much further below us. So we can take a short and we still haven't even made it to the opposing long, and that's also a valid setup. So you either need to get a short before we get to the 50 or take a short after we get past the 61.8. So this would be sort of an anticipatory trade, an anticipatory short, meaning, okay, yeah, we're starting to see some involvement up here. Participation at the 50. Now here we have a 28.0213, so I just round down, add a tick, 28.0175. That puts our stop at 03.25. So you'd be up in this range, and that would be, I'd consider that a valid short. Now we haven't broken the swing low, or the first 30-minute range here, so it's also okay to wait for that break to occur, whether it's letting the market touch its -23 and taking the next short setup, or letting it break the low. Maybe we get a little bit of a bounce here and then break lows. You can take that swing high down to lows. That makes a good setup sometimes. And then sometimes you don't get the retracement until we break down. So again, any 50% is a lower risk entry point. So you can never kick yourself for taking a trade at a 50%. Some ways to prevent yourself from getting chopped up or taking unnecessary stop outs would be to look at the distance between the 50 and the 61.8, and by the time you get your entry price, 0250s, and then add your 6 ticks, 04s. Now it's good to have that be outside of the 61.8 in this case, which the short was. But again, this is sort of setting up just like yesterday. I mean, almost like clockwork. So if we come down, tag the -23 here, I just draw up the next short and see if we can get into what might be a nice trend down to the close of yesterday. Now, of course, there's going to be times where the market runs and doesn't give any sort of opportunity to get in. But at some point, there will be a pullback, a retracement, a bounce. So you just can't get caught up feeling like this is the last trade that is ever going to happen. And if you don't get in now, you'll never place another trade. Almost having a feeling of nonchalantness or not caring, if you will. Well, yeah, I could get in the trade, or I could not get in the trade. If I don't place a trade, okay. I didn't lose any money if I didn't place a trade. But as I like to also relate it to playing cards, you got to pay to play. You got to put your ante in if you want to see your hand, or get a chance to see your hand. Would like to see the market go a little lower here, such that the 50% lines up with sort of the bottom of the first 30-minute range. This is you can sense that there are bulls present. We only traded down by a point or so. But at 2,800 and a quarter, we may get there. We get all the way to negative 23. We'll see. So 79.99's next short opportunity. We've come in quite a bit from that open, down basically at 1-to-1 breath. Don't have a low ticket lows. But that doesn't mean we can't rally off lows even if we don't have a low ticket lows. We've gone about halfway to the gap fill, so we still have a little bit of room. 89.50s, about 10 points left. I wouldn't be surprised if we kind of, maybe sometimes we stair step our way up to where we pull back into a long and that target is at the short. you are a trader who uses fundamentals or looks at, has a portfolio of some longer term investments, buying healthier companies or adding to your longer term positions on these corrections is definitely where a lot of money can be made. The goal should not be to make a quick buck, but the risk is considerably less, when you think about buying, even on any of these down days, something like Amazon, if you have that in your portfolio, or the NASDAQ itself, just waiting for those corrections. So we came up one tick away here. Did not get a touch. If we take a peek at the full halfway back, that's at 2,800 even, 2,850, we'll call it. When we come one tick away from an entry and don't get there, I don't like to drag my order in. Sometimes I will wait. In this case, we've got a very balanced breadth. We still have the gap fill below us. If this 50% long holds, the target of this little long is up just past the entry of this next short, and I would still take that short. Now we do have the larger high to low at 2800, and again, that 2800 kind of being a magnet that could make things a little bit wonky, trading through this short to 2800 and then getting a sell-off. Avi, we don't have a low tick that lines up with the current low price, so that's a good observation. We had 736, a low tick, but then we made a lower price, and we're out at 739s. So TOS needs a Control X or a clear drawing shortcut. Maybe if we have enough people suggest that, it'll happen. I wouldn't be surprised to see a bounce at the gap fill. So if we come down and fill the gap, if nothing's not getting an entry in on the way down, potential long at the gap fill. Sometimes that's just the way it goes. Market comes up to your price and either trades at it, and very rarely you'll get what I call a magic fill, where price just touches your order and fills you, versus trading through. And sometimes price comes up one tick away, and if you get in the habit of dragging your price in, what'll end up happening is you'll start dragging your price in on trades that the market was going to come up and tag the 50%. And if it does go in a little bit further, then you get stopped out because you're constantly moving your price lower, dragging your price in, chasing it. And so that's just not a good habit to get into. And we want to try and develop good habits. And so if anything, on a day like today where, oh gosh, market came one tick away and you didn't get into the trade, hey, it develops your patience. I mean, if you want, you got to look at some positive in it. Nothing really negative about it, but such is the way it goes sometimes. Because even if you put your order 2 ticks away and price touched 28.75s, there's a very good chance that it wouldn't have filled. And we just go in and one tick and then get some buyers coming in. Now we're at 1-to-1 breadth, very, very balanced. It makes sense as price is coming down. Yesterday's value area high is a 27.93.75. Now this makes total sense that we're bouncing here, because price likes to bounce at the previous day's value area high. So we've come down our third candle now, and what is our low? 94s. like this. Come right to the top of this value area. Now the next move from here should be, if we do move lower, should be right to the gap fill pretty quickly. Given us much. A little riskier, but drawing up from the recent swing high to lows. You have to break this little candle by a tick to get filled at the 95.75s. And it's possible that we bounce before getting all the way to the gap fill, or possible that we don't make it all the way to the gap fill. But at this point, it's not terribly far away from us. So there's a fill and a reaction at 95.75s. Sometimes the market doesn't give you the fill you want, but you just take what you can get. So both this larger -23 and the smaller one here are about the same, a 92s, we'll call it. I think you can go 92 1/4. Now that price has broken lows, take the stop. I'll move my stop down to a 96.50. Because if we go down here, if we just break in, there's a low tick. So there's a good chance we will get a bounce here, unless we can tick down now in the next minute or two. So we've formed a low tick at lows, and if we can't break this pretty immediately in the next minute or two, then that's where you get that stronger bounce. But if we can, in the next minute or two, just break through it and kind of break this low tick, then we'll be okay. Then we should move pretty quickly to 89.50s. So first target, we'll call it a 92 1/4. Well, we'll call it 92.50s. That way we're in front of this larger one. So I'm going to move that up to 92.50. And it's tightened the stop already. So even if we do come back, you reduce the risk on the stop. So that's why, if you look at your trades, your average loser is never really going to be a full 6 ticks, because this trade could turn around here and stop us out, quote unquote. But you've reduced your risk on the trade. But we got to break this low tick here, and it has to happen now. Not that we can't come up and retest and then sell off again, but there's a lot of buyers, or a lot of people, a lot of traders, watching out for these situations and trying to fade extreme ticks. Not that a minus 500 is super extreme, but it's the lowest tick of the day. So relatively, it's low. Now you could see that as, okay, just close out the trade, or take one off. If you got your two contracts, you could take one off at a low tick like this. The distance here, that's 3 points. That's good reward to risk, healthy, reward to risk. There's our break though of one tick without a new low tick. So now we've broken that alignment. You just don't want to get in the habit of micromanaging the trade. But it looks like there it is on top of one more tick. There it goes. So there's what I call the first target. So even if you have two contracts, I would still use the negative 23 as your first target and then trail the second. So at this point, just leaving the stop alone. If we bounce and then sell off, then I would lower the stop to the next swing high. That gap fill at 89.50s, I would just round up 2 ticks, 27.90s, and use that as the target for the second contract, which close. It's closer than I thought it was. Obviously, if you get the more contracts you have, the more you can scale out. But even with just a very simple 2 contracts, taking one off at the target and trailing the second is really the best way to approach it. Best for your psychological. Now that you've got one taken off and a reduced risk on the trade, market could come all the way back and you're still locked in profit. And then keeping that runner to be able to hang on as long as possible. Now with 3 contracts, that's when you can, like on this scenario, put one order at your second target, could be at the gap fill, 27.90s, and then your third could be a runner. Or if you've got 4 or 6, you can do, multiples of 2 off at the negative 23, trail 2, something like that. But through my own trading, I started trading more and more and more contracts, and then I scaled back, and I find 4 to 8 is plenty. You start getting 10, 12, 15. At least I didn't quite. I have a little bit lower risk tolerance than some of my trading colleagues, and I trade better with fewer contracts and letting them run. So even if you just have 2 or 3 contracts, you can take a lot out of the market with just 2 or 3 contracts. So, and that makes the goal more achievable. You don't have to, build up this massive account to get to trading 10 contracts. If you're trading 1 or 2 on Sim, and it's good to start with trading 1, and you really have to go one or the other. You have to either take it off at the negative 23, which is what I would do when I started with 1 contract, or you have to trail, but you have to do it the same way every time. So if you're going to trail, you have to be comfortable with letting it come back. And if you, here's another low tick, Nicholas, 801. You can also bring your stop. So now that we've got a 96 entry and we're at 92 is 4 points. If you want to bring your stop down, we've traded at the negative 23. You can also use the 61.8 as a place to bring your stop down, in the sense that, okay, if we come back and fail this next setup, there's a good chance that we'll move higher. So you could move your stop to a 94.50 if you don't want to leave it up at 96.50s. That locks in another 2 points, and you're not just arbitrarily moving your stop, you're actually using the market to give you a place to exit. And then that second contract, you can just, if we come up, trade at the 50 and sell off, then you just keep trailing your stop on the way down. Or you get a little bounce here and roll over, you can put it above the swing high, just like back here. Now with this low tick at lows here at 801, we've got this one candle bounce. I wouldn't be surprised to see some buying here to take us up into the 50% short, and even through it. So I've been using this 61.8 approach the last couple of weeks just because that's been working pretty well. So if you have a one or two, maybe three trail stop approaches, methods in your toolbox, you can just kind of look at the market and see what's working. But the idea is to be trailing your stop. So now, if this is all the bounce we get and we sell off, okay, that now our low tick divergence is broken. Now here's where you really get to capitalize, because now the stop goes from 96.50s all the way down to a 93s. So just one tick or two ticks above highs if you want to do that. So 93.25. Now you've got one off for 3 points, and your second contract has 3 points locked in also. And you're at 6 points on a trade with just two contracts, and you're still in the trade. You still got one contract running, and so just going to keep trailing this. Again, this 89.50s, maybe see a bounce here, but maybe go straight through. But I would rather try and stay in the trade as long as possible, as opposed to get in, get out, get in, get out. Because every time you put on a new trade, every time you open up a new trade, you end up with new risk. So now you're in a trade. Kind of going back to what I was talking about Bitcoin and taking out what you've invested plus some profit. Now, your emotional state should be pretty at ease with locked in profit here. And you can use the swing high as your trail stop. You could bring it down to the 61.8 if you want. Keep watching these low ticks at lows. It's possible that one of these sticks. But you'll notice too here how the bounces are very short, just a couple of candles. At some point we're going to get a bigger bounce that breaks the swing high, breaks the 61.8 and breaks the swing high. And that'll take us out of the trade. But in the meantime, you don't know when that's going to happen. And so very good habits and good practice. Practicing good habits is really the best thing you can do. So I think we'll leave it at that for this morning. Nice that we were able to at least get a little bit of redemption. Didn't get the short entry up here, but able to get in just a bit lower. Nothing wrong with that. And some good opportunities to talk about what we've been seeing in the markets, and in the markets, I would say delivering. You don't have to make 5-10 trades a day. All it takes is just being patient, but also not waiting until the close and not taking any trades. If there's a good setup, you have to be able to pull the trigger. So at this point, I've got my stop here at the previous swing high. A little bit of bottoming out here. Again, this is the gap fill. So if you want to bring it above the 61.8, that's not much. You're not really saving much here. Bringing it down, the distance between the previous swing high and the 61.8 is only about a point or so. But even so, even if it comes back up and takes me out up here, lock in a good trade on the morning. And if it doesn't, if it rolls over, then you just keep riding it down and following that same approach down. And if we come to lows and start breaking these swing highs, then you can just do the same thing on the way back up. Just draw from lows to highs, let the market pull back, get in the long, and then just start trailing the stop on the way back up. And then rinse and repeat. And if it's a day where the market is looking healthy and you're seeing the market touch at 50%, get participation at a 50%, then those are the days that you want to be, actively trading. If you're drawing the charts up and you're looking and you're saying, wow, the market's it's blowing through the 61.8. I'm not really seeing the setups today. Pull up a sim account and take some trades there, or just observe that day. And there's a very good chance that the reason that you're not seeing any setups is because the market's not giving you setups. And I think people forget that 30-40% of the time, sometimes 50% of the days are just range bound, challenging, choppy days. So just the better you can identify the type of day early on, whether it's using market profile, whether you're just looking at, pull up Friday's chart, a 5-minute chart of Friday, and then go back and pull up any other chart from the last couple of weeks, put them side by side and say, okay, what characteristics am I seeing on Friday? Well, we gapped up and then we started going immediately. How does that compare to a sideways day? Well, okay, we didn't gap up. We traded one direction, and then 10 minutes later, we traded a different direction. Then you start to pick up on those characteristics, and that's what forms, that intuition. And then you can really further your trading to the next level. So here's another sell-off, making a new low. So now you can take your stop and move it just above this little, not really a bounce, but it's the next swing high, if you will. So a 90, you can use a 91. You can go 2 ticks if you want. 91 1/4. But just following some sort of repeatable process is the best thing to do to develop an approach that you can use for years and years and years. So thanks everyone for tuning in. Thanks for everyone. I know there was a handful of folks who was their first time today, so thanks for joining the room. And as always, if you have questions or if you want to talk about specific situation to your own trading, feel free to shoot me an email, tim@eminimind.com. And I hope everyone has a great week, and we will talk to you soon.